Welcome to Phillip Mastermind. I'm Kim, and in this webinar, we'll be sharing our thoughts on ESG investing in Malaysia. ESG, which stands for Environmental, Social, and Governance Investing, is an investment style which incorporates sustainability factors when making investment decisions alongside traditional financial analysis. ESG investing evaluates how a firm could contribute to ESG goals and have an impact on society in addition to maximizing profits for its shareholders. The table highlights some of the key ESG investing factors. Environmental factor includes climate policies, energy efficiency, waste management, all aimed at reducing greenhouse gas emissions. Social factors consist of health and safety, labor standards, diversity and inclusion, while highlighting the growing significance of supply chain management in shaping global manufacturing. Finally, governance factor incorporates anti-corruption measures, transparency, corporate governance, among others. Note that the list is not exhaustive. Over the years, we see growing demand for ESG investing, and that reflects investors' focus on sustainability and achieving net zero carbon emissions, shaping long-term investment strategies. Before zooming into the ESG dynamics in Malaysia, let me share with you how it all started. The goal of achieving net zero emissions by 2050 is a response to the pressing need to address climate change. To limit global warming to 1.5 degrees Celsius and avoid the worst impacts of climate change, the IPCC has recommended achieving net zero emissions by 2050. According to McKinsey analysis in the Transition to Net Zero report, achieving net zero emissions will require a substantial transformation of the global economy and significant investments. The report estimates that between 2021 and 2050, around $275 trillion will need to be spent on physical assets for energy and land use system as part of this transition. This translates to an average of $9.2 trillion per year, representing an annual increase of up to $3.5 trillion compared to current levels. We see pockets of investment opportunities within the renewable space. The transition from fossil fuel to clean energy is central to accomplishing the goal of net zero emissions. This chart illustrates the anticipated transition towards renewable energy consumption in the upcoming years, which include hydroelectricity, solar, and wind. This implies that the companies involved in these sectors are likely to benefit. EV is also booming. EVs offer a compelling solution to the environmental challenges associated with traditional ICE vehicles. Numerous countries are also undergoing a transition towards the adoption of zero-emission vehicles. According to IEA, with the implementation of ambitious policy programs in major economies such as the Fit for 55 package in the EU and the Inflation Reduction Act in the US, the market share for EVs is anticipated to witness significant growth in the coming decades and beyond. By 2030, it's projected that EVs will constitute approximately 60% of total sales in China, the EU, and the US combined. Rapid electrification of the automotive sector is having positive knock-on effects for battery production and supply chains. As shown in the picture, the EV supply chain starts with the sourcing of raw materials and specialty chemicals, which are utilized in the production of EV-specific auto parts. These parts, including batteries, auto components, and technology components, are then integrated into EVs. So, when we talk about EV, the supply chain itself can be huge, involving different stages of production and distribution, each making their unique contribution towards advancing ESG principles. Malaysia is actively working towards achieving carbon neutrality by 2050. In July 2023, the government has introduced National Energy Transition Roadmap (NETR). This roadmap outlines a strategy to expedite the nation's shift from a conventional fossil fuel-driven economy to a more sustainable green economy. The government now aims a higher 70% RE capacity target by 2050 from 40% earlier. This roadmap includes 10 flagship catalyst projects and 6 key energy transition drivers, namely energy efficiency, renewable energy, hydrogen, bioenergy, green mobility, and CCUS. Collectively, the successful implementation of the plan would have the potential to generate significant investment opportunities for energy transition, ranging from 435 billion ringgit to 1.85 trillion ringgit by 2050. And in this decade alone, the government would need to allocate between 60 billion ringgit to 90 billion ringgit for essential spending, such as enhancing grid infrastructure and upskilling the workforce. These figures show some of the long-term targets upon 2050 across the 6 energy transition enablers. In addition to the commonly mentioned objectives of achieving a 70% renewable energy installed capacity and becoming coal-free by 2050, there are also notable targets concerning CCUS, with plans for 3 to 6 CCUS clusters and a CO2 storage capacity of 40 to 80 million metric tons per annum. Furthermore, there are goals related to hydrogen, including the production of up to 2.5 million metric tons per annum of green hydrogen, the establishment of 3 hydrogen hubs, and 100% green hydrogen feedstock phase-off. Additionally, bioenergy goals involve achieving a capacity of 3.5 billion litres for biofuel production and generating 1.5 gigawatt of bioenergy power. These targets are further detailed with specific milestones to be reached by 2030 and 2040. Additionally, they offer various investment opportunities across different phases of their implementation. On a separate note, there are also efforts made by Malaysia's Securities Commission and Bursa Malaysia. The SRI Sukuk framework was introduced by Malaysia's SC in 2014, setting the foundation for the nation's transition to sustainable, responsible investments. Since then, the SC has remained supportive of several programs designed to promote a sustainable capital market in Malaysia, such as the implementation of the SRI roadmap for Malaysian capital market. Additionally, Bursa Malaysia and its index partner, FTSE Russell, have been evaluating the ESG practices and disclosure of PLCs in order to match business sustainability initiatives with investors. As a result, the FTSE4Good Bursa Malaysia Index was then introduced in December 2014. It's made out of constituents of FBM emas that meet a variety of ESG criteria as defined by the ESG ratings evaluated by FTSE Russell using its ratings methodology. The FTSE4Good Bursa Malaysia Syariah Index was then launched in July 2021 by Bursa Malaysia and FTSE Russell to meet investors' demand for ESG and Sharia-compliant index solutions. The FTSE4Good Syariah Index is designed to track constituents in the FTSE4Good Index that are Sharia-compliant as determined by SC's Sharia Advisors Committee screening methodology. As of the latest review in December 2023, there are 109 and 88 constituents listed on the FTSE4Good Index and FTSE4Good Syariah Index respectively. In line with the nation's goals towards sustainability, Phillip Capital Management (PCM) has integrated ESG factors that we attest as material and relevant for a company's financial performance and long-term sustainability into our investment decision-making process. These include, but not limited to, ESG ratings by established index, environmental considerations such as climate change, natural resources preservation, and pollution and waste, social considerations, health and safety, community engagement, employee relations, and governance considerations, board independence, transparency and disclosure, shareholders' right. Separately, PCM offers discretionary portfolio that invests in stocks with high ESG ratings from FTSE4Good Bursa Malaysia Index and FTSE4Good Bursa Malaysia Syariah Index, namely PMAC and PMA ESG. There are both conventional and Sharia options available. PMAC and PMA ESG is suitable for investors who want to optimize the risk-adjusted return by constructing a diverse sustainable portfolio of ESG companies. In our previous video, we shared that in the face of challenging 2023, most of our private managed accounts were able to register positive returns, outperforming KLCI, which declined negative 2.7%. Our humble performance is credited to effective bottom-up stock selection and prudent management practices, which allow us to navigate the market effectively. We avoid trying to time the market, focusing instead of investing in companies with strong fundamentals, sustainable business models, clear earning visibility, and a high-quality management team. This also applies to our approach when managing our ESG mandates. Our ESG mandates come in both conventional and Sharia options, catering to investors seeking to optimize the risk-adjusted return by constructing a diverse, sustainable portfolio of ESG companies. In 2023, our ESG mandates demonstrated robust performance, achieving a positive return of 9.70%. This performance surpassed KLCI, which declined negative 2.7%, and exceeded the FTSE4Good Bursa Malaysia Index, which saw a modest increase of 0.7%, while the FTSE4Good Sharia declined marginally by negative 0.3%. This favorable performance extended into 2024, with our ESG mandates for conventional achieving 7% and Sharia achieving 4.7%, aligning closely with KLCI 5.6% and FTSE4Good Index 6.6% and FTSE4Good Sharia Index of 5.6%. While the past performance is not necessarily an indicator of future performance, we remain committed to achieving sustainable performance over the long term. You might wonder what leads to the outperformance of ESG mandates. Well, ESG stocks tend to enjoy stronger valuation and profitability attributed to their adept risk management, innovative operational efficiencies, alignment with regulatory compliance, and enhanced reputation and brand equity, fostering high shareholder returns and better profitability. Indeed, according to Bloomberg consensus data, the KLCI is projected to witness earnings growth of 8% in 2024. However, the FTSE4Good Bursa Malaysia Index is anticipated to experience growth of 13.3%, while the FTSE4Good Bursa Malaysia Sharia Index is forecasted to grow by 19.8%. The KLCI, predominantly comprising traditional sectors like financials, plantations, telcos, and utilities, exhibit slower earnings growth. Conversely, the FTSE4Good Index and the FTSE4Good Sharia Index include growth sectors such as manufacturing, industrial, and technology, thereby explaining their robust earnings growth. This variance in earnings growth help explain why the price-to-earnings ratio of the FTSE4Good Index at 13.6 times and FTSE4Good Sharia Index at 17.2 times trade at a premium compared to the KLCI 13.4 times. Notably, the FTSE4Good Sharia Index commands a higher PE, primarily because it excludes banking stocks, which typically trade at a lower PE due to their mature business nature, thereby influencing the overall valuation dynamics. Here is the list of stocks in our ESG mandates. For conventional, we have names like automaker BOAuto, credit reporting agency CITOS, offset player Inari, USB gas delivery solutions provider KGB, property names such as Legenda and Matrix, blue chip names such as Maybank, Public Bank, Sandabi, plantation company Sanplan, telco player TM, utilities company Tenaga, and FPSO player Yinsen. These stocks have been chosen based on their fundamental qualities, earnings quality, and ESG ratings. The Sharia-compliant portfolio includes similar holdings with the exclusion of conventional stocks like Maybank, Public Bank, and Yinsen. The management approach for both conventional and Sharia-compliant mandates is similar, where we select stocks based on their fundamentals and earnings, as well as the ESG ratings. We believe listed companies with good ESG practices will continue to benefit from the rising sustainability trend. Furthermore, we have pinpointed selected names within the key sectors such as constructions, renewables, utilities, and property that stand to benefit from the National Energy Transition Roadmap and the policies outlined in the Budget 2024. As companies enhance their ESG performance, we foresee a reduction in the risk associated with foreign labor dependency, a factor that historically affected industries such as plantation, construction, gloves, and EMS. With supply chain increasingly prioritizing ESG criteria, ongoing government and corporate initiatives will help mitigate the risk of sanctions and reputational damage. This is crucial amid heightened ESG scrutiny. In addition to that, we believe that by diversifying and allocating investments across various stocks and sectors, the strategy reduces risk by lessening the influence of any single investment's performance on the entire portfolio, thereby increasing the portfolio stability and long-term risk-adjusted return. Finally, we'll consistently assess our holdings and adjust our portfolio as necessary to align with prevailing market conditions. In Phillip Capital Malaysia, we have a wide range of private managed accounts, PGWA, and unit trust funds that could cater to different investors' needs. Whether you want to DIY, seek for advice, or let the expertise fully handle your portfolio, our platform, with a comprehensive list of products, including discretionary private managed accounts and unit trust funds, can cater to your needs and preferred way to achieve your financial goals. That's all for today. Stay tuned for our next Phillip Mastermind. This update is brought to you by Phillip Capital, your partner in finance.